Hey everybody, hey traders, happy Wednesday. I was just listening in on the FOMC press conference with Jerome Powell. He's still going. Price action today is typical FOMC day. A lot of chop, a lot of anticipation, a lot of levels. 600 was the level I called out this morning. We're trading around 604. I said 600 to 610. We hit 600. We didn't breach. We kind of snuck in there, but then snapped up side right back where we started. So FOMC day thus far in the final hour of trading. Maybe some follow through post Fed. He's still doing. Jerome Powell's still doing the press conference. Is there anything to get this market to break and try to sneak up to that 610, or will we break fresh lows and get down to 590? I did see a big level down to 595 and 590. I am playing the SPY both ways until the end of the week. So I have a 609 by 611. That's a bull call spread. And I have a 601. I'm sorry, I did that backwards. A 591 that I'm holding as is. I'm thinking of adding a 589 to give myself basically a $2 credit target with about a 30 to 40 cent debit. So if either one of these levels get hit, it gives me an opportunity to at least grab some net profit. I would like to think that my liquidity levels will be hit by the end of the week. We still have Mag 7 earnings that come out tonight and tomorrow. So between today's aftermarket, we've got Tesla, Microsoft, Meta, and then tomorrow aftermarket we have Apple. So that's some pretty big movers and shakers with market cap for some post earnings. We also have PCE on Friday, which is the next big round for inflation data. I did see a couple of interesting things that I pointed out in a previous live session. So the Trueflation reading, which I watched this third party inflation reading quite closely. We basically bottomed out when I thought we would bottom out, and that was when the Fed started to cut rates. Inflation started to bottom and start to rip higher. We came back and retested basically the highs for the year. So we had March of 2024, April of 2024, and December of 2024. We got right back to the same inflation levels. Now, what I am liking thus far is that we are at least going lower in a real-time inflation environment. Okay. But does that mean that we go to a higher low and start to get back up to higher levels? I don't know. Remains to be seen. If we take a look at I'm trying to think, the news for Friday. So news for Friday is our PCE, the personal or the core PCE and the PCE price index. So that would be our PCE is that personal consumption. I can't remember what PCE is. I know it's inflation. The heck does it stand for? Okay, difference in core CPI. Personal consumption expenditures. Yeah, so that is the Fed's preferred measure of inflation. Core PCE does still exclude food and energy. I couldn't find on the forecast. I wanted to find the year over year, and I have it through. I think I found it through what was it? MyFX book was the economic calendar that showed it. So we are looking at the previous, and I'm looking for year over year. So the previous PCE price index was 2.4, and the new forecast is 2.6. But the Fed's preferred gauge is core PCE, which the previous print was 2.8, and this Friday's expectation and forecast is also still 2.8. Now, that is pretty close to what we saw January 13th and 14th when the market got that CPI data and the market went way higher, which I do think was an overreaction because it still showed higher inflation, but it was essentially close to forecast. So anyway, possibly the market still likes this idea of like, hey, we're less than 3%. It's not the end of the world. Maybe that's the case, right? But this is more news on Friday. So Mag 7 on Wednesday, Thursday, after market, Friday PCE, looking to see if the SPY is going to hit 595 or it's going to hit 610. Those are the two levels I'm watching. If we have a bigger move to the downside, 590 does come in handy, but I'd be happy right now getting a 595 or to the upside 610. So those are two levels that I'm going after. Okay. The reason I wanted to have today's session, number one, I'm typically doing this every day for the final hour. But number two, I posted a trade for my daily profit play service. And this is a little bit more advanced, but we've talked about this a lot through December. We did some bonus sessions, mastermind classes on my daily profit play, going out a little bit farther than just the 0 DT that we typically do every single day. So I post that video here in the Telegram channel for daily profit play. It's about 20 minutes long. And I'm walking through on my broker platform what I'm doing with some of those open positions. So I wanted to take another quick look at that today while I have this last hour here, and I can possibly look at another roll. I want to see where my strikes are at for the SPX 228 expiration. I have a 54.90 and 54.85. Let me find that right here in my platform. So this is an SPX trade. Oops. So positions, SPX. Let's see here. 54.90. 54.90 and 54.85. Got to find it over here to get rid of it. Oh man, there's a lot of trades going on here. There's a lot of fills on the old SPX. 54.90, 54.85. This trade right here. Okay, so that trade is trading for about $1.85 right now, and I got in for about $1.30. So it's manageable, but I'm going to go ahead and cancel the pending closing order and look to roll. If I look to roll this, let me roll these to an appropriate strike. So I'm going to go back to the 15 delta and see if I can roll this and keep it 5 wide. So I have a 50. Yeah, this is fine. So I'm going to go, let's see here. I can do the 56, 57. Oops, this is backwards. Gosh darn it. Make sure I'm doing this correctly. So what happens when you got a lot of positions running? So the 5490 should be a sell put. 5485 is a buy put, and then do a roll. I don't know why this roll is backwards. So it would be, that's correct. And then I want to be flipping this and moving this down to a 15 delta. All right, so let me see if I can get here on that roll. So I'm going to take the 54. Oops, that was way the heck off. Hang on a second. And it's a little frustrating where it's like the strikes change, the expirations change. Now I've got the same strikes. I need to roll this to a 15 delta. All right, let's try this. So I'll roll these to the 15 delta, which is probably going to be in the 56s or 57s. All right, so if I go 57.50, not getting a lot of premium there like I would like. 16 delta. So that's kind of close. I could do a 16 delta, so I roll the 54.80 by 54.75, and I roll that to a 57.70 by 57.65, grab maybe 35 to 40 cents credit. That gives me a net $1.70 or so, which reduces the size of my overall risk. Yeah, so what I'm doing is I'm right now, the strikes that I currently have are way down here, right? So the 54.80, I mean, it's way down here. So these puts are basically in full profit, right? I mean, these are trading for next to nothing, which means my put side is profitable. The issue is I have a call side of the trade, which is 61.60, and we're trading right now about 130 points below that. So my call side, 61.60. This is a 31 delta. So this one's not as threatened. I think I don't need to roll that one. I think I'm good. I'm gonna chill onto this one a little bit longer. So let me go back to that trade and find 5490 by 85 and a 6160 by 6115. Oh, that's not the right one. Get rid of those. 6160 by 65. That trade. So if you're following along with my daily profit play, this is line 25, trade 699. It's this trade right here. So the 6160 by 6165 and the 5490 by 5485, I'm going to issue that closing order at my 15% take profit. And that should still be the trade. Okay, I'm going to put this back in for $1.10 and no adjustments needed on that one. Okay, so line 25 is still fine. Let me take a look at XSP. I think that one probably deserves a bit more of a roll. Yep, I'm going to go XSP. That one probably needs to get rolled because that one's close to the SPY as well. So XSP, this one is probably worth a roll. It's a 228 expiration, the 612 by 617. Current price is 604. We're way higher in the deltas on the call side. So the 544 by 539 right here, I'm going to look to roll this. So let me move the strikes and move back the expiration. So same expiration and find my 15 deltas. Okay, so if I go to a 576 by 575, switch these around. There we go. So if I have the 544 539, that's my bull put spread, and I'm going to roll that to a 5 wide there. That's a little bit better. That's a 15 delta. Okay, so I keep the 5 wide, try to get 30 to 35 cents credit on this one. I'm going to roll those puts. 576, that'd be a pretty good drop in price. If we dropped, let's see here, that'd be 28 points out of a 604. That'd be a 4.5% move on the SPY or XSP in the next 30 days. That's a pretty big decline. I'm not saying that it can't happen, but based on current option chains and mechanics and deltas, it's a lower probability. Hopefully we have about a 20-point move as expected, and that would only put us down to about 680 or 585. So I'm going to try to roll this for 30 to 35 cents or 34 cents. It's a bit more liquid than the SPX, and I can go by the penny. So I'm going to try to get this one for 35 cents if possible. So 35 cents, trying to roll. See if this will fill. This one, 39 and 44. See if I get 30. I'm going to try to get 40 cents out of this one. So not getting it. Let's try to get 35 cents for this one. Okay, let's penny this down to 34. Got filled for 34 cents. Okay, so I'm going to add this one. This is line 22 in my daily profit play, trade 702. If you're following along, you've got the daily profit play course. So I'm taking the 120 and I'm rolling rolled puts. So I have the 576 sell put, 571 buy put, and collected 34 cents credit. Rolled puts. Yep, perfect. All right, so that trade is in. Let me see. I want to make sure I do this correctly on each one, but I'm going XSP, taking the 539, 544. So 544, 539. Doing a roll to the 576, 571. Keeping the same expiration. All right, so let's go into these other accounts here. XSP. Okay, maybe I just did it in that account only. I mean, that'd make my life a lot easier. Okay. XP. I closed this trade out yesterday. 950. Okay, that's profit. XSP, no exposure on that one. No exposure on that one. No exposure on that one. Nope. And nope. And nope. Okay, good. Well, that makes this a lot easier. So XSP, I just did a roll. And now I have a 612 by 617 and a 576 by 571. That trade totals $1.54 credit, and it's still the same expiration. And I'm going to see if I can get that thing closed out for a profit. So that's the new trade. I just rolled the puts. Now, the other trade I have on XSP, SPX looks okay for trade 703. 621 in the XSP looks okay. Those are okay. I'm okay with that position. And even the SPX on the 27th, that was way more volatility, higher IV. I'm fine on that one. So, okay. I'm going to make a note here and add to this. So XSP 228 expiration. That trade that just got rolled. I still have the 612 by 617 bear call spread. And originally, I had the 544 by 539 bull put spread rolled up to 576 by 571, and that was for 34 cents credit. Okay, so that is it. I know that was a lot of stuff that we didn't really want to have to deal with, but unfortunately, price has retested all-time highs, and that was roughly where our call side was. So I'm still taking heat on the call side, but this is one way that I look to roll, right? Papa John was asking me about this in Discord. There's a couple ways to roll, and I've had these conversations in a lot of one-on-one sessions, which I hope this helps. But I'll give you a little insight to it. So, when or how to roll. So there's a couple different examples. Like I don't roll a lot, okay? Rolling is about keeping the trade alive, and you can do that by giving yourself more time to be right, and I'd say for profit, okay, or break even for that matter, or recentering a trade for better mechanics and likely reducing overall cost, reducing overall risk, and again, giving the trade a chance to work. And also, you can roll for income, and mainly I do that with covered calls or cash secured puts. All right. So the trade that I'm talking about is if I'm doing basically it's, if I look at an iron condor or a short strangle. Okay. So today, for example, I did an iron condor on oil. I did it on CL, which is futures for crude light or crude oil. But I'm doing it here on the SPX or the SPY, the XSP, QQQ, whatever. Point is, this is what I like to do. If I place we'll say iron condor, okay, iron condor, which is a risk defined version of the short strangle. Okay, if I play an iron condor, which just gives me price can go through the moon or crash to the floor, and if I'm doing the credit spread, there may be assignment risk, but usually the trade just sets up and you just take the defined risk as is. But I like to take these trades and sell some premium, especially when we have higher implied volatility environments. So what I like to do is if price stays relatively centered from the strikes. So let's use an example, okay? Example would be, SPY is trading at 600. So we're trading at 600. And I sell an iron condor with let's say the 630, the 630 by 635. That'd be my bear call spread. And let's say the 570 by the 565 bull put spread, right? Those are the two trades that add up. All four of those add up to the iron condor in total. Okay. So if I sell an iron condor 630 by 635 or 570 by 565, and the SPY in the middle is trading right around $600, the closer and longer SPY stays around 600, the faster this trade hits profit. Type in a wire yes, so that makes sense. So if I placed a trade where this is center price and I sell premium here and I sell premium here and price just does a little bit of this, it doesn't really move a lot. The time decay on this position for me allows me to take profit here, and then a lot of profit towards the end. Now, what I like to do is if I have this first third or this second third of the trade, that's when we collect about 75% of our profit potential. When about that 2/3 of the trade. So that final third is where I don't like to have it's called gamma risk. It'd be your outlier risk. It'd be if price makes a big movement towards the end of that expiration cycle. That's where there's the most risk on the trade. So if we can collect a majority of the profit, take the trade off. So if I can go after like a 25% winner or a 50% winner, those mechanically are very sound trades. Does that make sense? Okay. So the faster this trade gets into profit, that's because the closer and longer that asset would stay around the center price. Okay. Now, in the example that I just talked about, if SPY drifts up to, let's say, 620, and the call side is threatened, rather than moving the call side out farther and up away from current price, okay, which is fine, but this realizes a loss. Okay, so rather than doing that, what I'd prefer to do is I would rather move the untested put side up and closer to a new center, right? So in this example, if I had originally it was at 570 and now the SPY's up to 620, well, that's about a 20-point move. So I could do the SPY 570 by 565 and roll up to, and I try to keep the same expiration, so it's the same trade, but I could roll up to like 590 by 585, right? So if I roll it up to 590 by 585 for a credit, this books a win on the original put spread and adds more credit with the new put spread. Okay? And what that allows me to do with that trade is now, if price, which we're going to say has moved up to 620, at 620, ends up staying at 620, okay, or falling to 615 or 610 or 605, we can turn this overall position into a slightly bigger winner. Okay? But there's still risk in the trade. So I know this isn't just a freebie by learning how to roll. But if price goes higher than 630, my call side is now in jeopardy. My put side has helped me reduce the cost of the trade and reduce my overall risk, right? So it doesn't mean that I roll and automatically get a winner. Doesn't mean that at all, right? What I'm looking for is, will it be possible to keep price still within the center prices that I initially elected for the trade? And if it goes through the call side, so be it. If it goes to the put side, so be it. But all I'm trying to do is, if I'm going to take on risk, I'd rather take on less risk. If somehow it doesn't breach my call side or breach my put side, I can turn it into a profitable trade. And yes, I rolled it, and it's more mechanically centered now. But if I do a roll, at least my untested side, rather than being at like 99% profit, which a lot of my puts were right now, it's at 99% profit, which means for doing nothing for the next 20 to 30 days, I only get like 1% of that remaining trade. So I might as well roll it, get some more credit for it, reduce the overall cost of my trade, reduce the risk of my overall trade. And if I can still carve out a winner, great. Let's carve out a winner with a couple extra bucks. Okay? So does this make sense? Type in a why yes, this makes sense. So do I love this trade? It depends. Okay, when I do this stuff, when it comes to like iron condors or longer dated options like this, I'm looking at like the 45, 60 day. That's very typical. Tasty Trade talks about this all the time. It's there. If you want to read the book, it is Unlucky Investor's Guide to Options Trading by Julia Spina. It's the short strangle that Tasty really likes. They like undefined risk. They do a lot of SPY strangles. That's where most of their like 30 plus year studies are based in. The last 20 years or so, they do SPX strangles as well, but you have to have crazy buying power to do an SPX strangle. I mean, you need like over 100 grand to do that on a portfolio margin account. So I don't do that. I just do a lot of iron condors. Anyway, the point is, I love this trade. Okay, I love this trade in a high IV environment. Period. So what I'd like to see would be index-wise. So if that was SPX, SPY, NDX, QQQ, even XSP. If you're trading futures, you can go ES, you can go MES, and you can go even NQ and MNQ, right? These are all the index-related symbols between equities, ETFs, and futures. You can take these trades, but I want to see higher IV. So last year, for example, I'll just make some notables here. Last year, we saw index IV, and IV meaning implied volatility, right? Implied volatility less than like 5, right? And low teens most of the year. That's a very low implied volatility environment, which means doing these trades, if we just had like mostly a bull market, your call side might get threatened regularly, and so you can play around with like, okay, if we're in a bull market, maybe you can move the put sides up to a higher delta, call sides up to a lower delta, and therefore stay, a little bit skewed where your put side collects more premium because you think the market's going to go higher, and the call side stays out of the way to kind of try to collect that premium and still get premium on both sides of the trade. But when we're in this really low volatility environment, it means you collect less premium per trade. Less premium per trade. So my preference is if we see like 15 to 20 or higher, I look for this trade. Okay. And the kind of the outlier examples last year, outlier examples in 2024 would be August and briefly in September right after Labor Day, and then in December during the holidays. The IV reached, pretty good levels. I mean, August, we saw like 60 plus in August, which was massive. And even that was like, I mean, because we had a down move, like I wouldn't necessarily want to do like iron condors and strangles. What I would have done instead is just doing puts, right? We had a 10% discount on the S&P, just do put spreads, just the put side of the thing to see if the market bounces, because the call side ripped back. I mean, August to September, the market came back and basically eradicated the entire move we saw from August 2nd, 5th. It took out the entire move from basically the high of July into that bottom in August 5th. So anyway, but the IV reached a really, really high level, and it was crazy amounts of premium to sell. So that was pretty solid. And then we had roughly like 25 to 30, 25 to 35 in September and December, while the market was, September was brief. It was like a, basically post Labor Day sell off. The market dropped like 2 or 3% in like a 1 or 2 day window. And then December, we had like 2 to 3% swings up and down, and the IV got a little bit higher during that time with thin market conditions. So a pretty good time to watch and pay attention and take advantage of those premium opportunities. Okay. Does that make sense? All right. So if I've got people watching that are in the daily profit play, I think we're good. Like I'm good on these trades. I just made the adjustments on 3 positions. We'll talk about these more tomorrow in class. But I think as it stands right now, I only have, so I rolled on 3 positions, and the other ones looked okay because we were selling at a better center price, and we also sold with higher volatility and higher implied volatility. So the distances away were a little bit better. And I'm just going to let those run for right now and not mess with those trades right now. But I'm rolling 3 of them. Okay. All right. So how or when to roll, I think that covers it as far as like an iron condor short strangle. A little bit more, I might as well talk about it, and I'll just finish the thoughts here. Rolling. Okay, when it comes to covered calls, and I do this a lot, covered calls, if you can roll for more time, more credit, what does that give us? If you roll for more time, more credit, that means you can lower the net cost you can increase the net profit, and you can possibly prevent the shares from getting called away if you want to keep the shares. For example, I'll give you one right now. I am likely going to lose my shares in Apple because my covered call is at 225, but I've been consistently rolling that from like 205 to 210 to 215 to 220 because the premiums were decent enough to do so. But I now have a covered call. I have own shares that I've drilled the cost basis down to like $157, and I have covered calls at 175, and I've got covered calls at like 200. Now the 175, I can keep rolling. Now I can't roll it up in price, so let me move this up a little bit. Okay, so here's an example, and I'll make this a little bit simpler. Let's just start from scratch. Okay, so if I do, let's say covered calls are your own shares, right? So to roll covered calls, you need to own the underlying. So let's say that I have shares of Apple. This should just be an example. So if I have 100 shares of Apple, 100 shares of Apple at a $200 buy price. Let's say I bought shares at $200. Okay. And right now, current Apple price is, let's go to current Apple price. We're looking at around 239. 239. Okay. So I have some choices. I can look at the 20 delta sell call. I can look at the 15 delta sell call. I can look at the 10 delta sell call. Now, pop quiz and question for everyone. I already did them, Francois. I did them yesterday. I did them yesterday live in this session, man. What did you do? Did you miss that? Aren't you in these sessions a lot? I did Microsoft. I did Meta. I did IBM, and I did Tesla. I did all those trades yesterday during this live session. So my covered call, if I want to look at one price, is 239. If I looked at a 20 delta, that's probably going to be a strike price of around like 245 or 250. Let's just say this is an example. Let's just say it's a 250 strike. Okay, and if I go to a lower delta, that's going to be a slightly higher strike. So 255 strike and let's say 260 strike. So the benefit of a lower delta covered call is that if price appreciates, so if Apple continues to go up to 240, 245, 250, I don't get the strikes called away. I don't get the option called away or the shares called away unless the current price is above my strike. Okay. The other way that we can trade this is I can also sell the in the money or at the money covered call. And why would I consider doing that? We get more premium, and that means we lower our net cost. And if we lower our net cost, that means we increase net profit potential. Okay, the downside of doing that would be you'd limit the upside appreciation. So when I repair trades, I say this a lot. It's like, okay, I'll take the ratio spread or I'll take the puts. If I get assigned the shares, I will repair it, right? I say that a lot. So if I'm repairing trades, I'm usually not looking for out of the money covered calls. I'm looking for something like at the money, slightly in the money. I know my cost basis. I keep working the cost lower, and I just want the stock to get called away for profit. That's what I look to do. Okay. So if I did an at the money for Apple as an example, let's say that I did a 239. Okay, an Apple 239 covered call, which would be a sell call, right? That's a sell call. Let's say that the broker gives me, $3 credit. And if I do an Apple 235 covered call, and that's a sell call, this is just an option, I should at least get, if the current price is trading at 239, I should at least get $4 for that covered call. I'm hoping that I can get like $4.50 or $5. And that would be worth it because I'm essentially getting a little bit more premium to lower my cost basis. If the shares get called away, they get called away, but they're giving me like an extra dollar or an extra 50 cents profit. Does that make sense? Okay. So let me type these out. Where did all that stuff go? There it is. I was like, where'd all my text go? All right. So when I'm looking to roll it, I would like to roll out further in time to get more premium, which means I want more credit for the trade. If I get more credit, I'm trying to lower my cost basis, increase in that profit potential. And if I believe that I want the share price to go higher, I'm trying to always roll out of the money, out of the money, out of the money, out of the money. If I want the stock just to get called away to repair or take some net positions, then I'm trying to basically, get it rolled into an at the money position, or even in the money if I want to get the stock repaired and called away. So a lot of the trades I did from September to now, September of last year to now, I did a lot of these like covered calls and rolls and repairs on some of these China plays. I own some shares in Alibaba. I own some shares in Baidu. I own some shares in JD. I own some shares in OXY. These are repair trades. Now, Alibaba and Baidu, I don't mind sitting on a little bit longer because I do think China has potential to have a good year this year. And if so, I want to try to stay out of the way. But OXY, I'm looking to get out of that thing for $50. JD, I'm looking to get out of the thing for like $39 to $40. And I'm repairing that. Now, I've lowered the cost basis in all those. My cost basis on JD is down to $35.92, and my covered call is at $39. So if I get that called away, it's going to be $3.08 per share, and I've got 500 shares. So 308 times 500 is $1,540 if it gets called away. Okay, I mean, that's an income trade. Now, when this initially started, I was looking at about a $500 winner, and now because of options, I've been able to lower my cost basis to hopefully get me about a $1,500 winner. It's not bad. Okay, OXY. Let me look at that one. OXY. I now have the break even at 48.63. And if it gets called away at $50, so 48.63, get it called away at $50, I make $685. That one is a repair trade. I wasn't sure what oil is going to do. I think oil is crazy volatile and indecisive. I don't know we're going higher or lower. But if I can get it called away at $50, I'm going to make $685. And that's going to be a 221 expiration that I have running right now. Okay, let me see the question there from Thomas. When you usually roll the covered calls, if the underlying equity moves suddenly much faster than you expect? Yeah, so basically when I look to roll, when do I look to roll? Like the first instinct I have is when the market does something like a big day, like a big sell-off day or a big red day when all of a sudden implied volatility goes up, or there's a big move on the stock that goes, for example, if you want higher implied volatility, you're going to have to see the market drop off. Like that's the downside is if you want higher volatility, the market's typically selling off. Okay. But that's a good time to also collect premium. That's a good time to also add exposure to selling options in the market. Whether you're selling options on current positions or rolling on current positions, or you're adding fresh positions. Higher IV is it's a better environment. And it doesn't happen very often. But you can be very opportunistic with high probability trades when the market sells off and you see some bigger jumps in volatility. If you take a look at Tasty's platform, for example, their like watch list. You can just go to Tasty. They've got Tony Batista's watch list. You got Tom's watch list. You got their just kind of general Tasty watch list. Tasty default. So you got all these instruments here. You've got indexes. Not a lot of stocks in here, but a lot of indexes and futures. If you go to, let's just say, high option volume. This is a good one here. A high option volume and super liquid symbols. Now we got some big names here. This is like the most liquid stuff in the world, right? So if I go to IVR, Palantir right now has an implied volatility of 93.5. That is crazy, crazy high. Earnings on the third. Now, there should be ability to collect a lot of premium on Palantir. Okay? SNDL, I don't even know what that is. That is whatever. I'm not going to trade it. EPD, Enterprise Products. You've got MRK. That should be Merck & Co. That's trading. We must have earnings coming up for some of these, like 86 on Merck. That's pretty up there. Intel. Intel trading at 1976. And earnings are tomorrow after market. Save, that should be, is that Save a lot? Or is that one delisted? AMD for Micro, that's Advanced Micro Devices. High IV, AVGO's Broadcom. LVS is Las Vegas Sands. We're down to $43. That one's coming back into a pretty attractive level, I think. Shopify. So, this is a nice way to kind of look at which stocks have good IV in order to consider selling premium. Now, be mindful that, yes, there's earnings on these stocks over the next couple weeks. So if you look at the combination of implied volatility changes, if I go a little further out here, so the IV 5-day change, which ones have changed the most? So SNDL has jumped up 112% in the 5-day implied volatility. That's a lot. Lucid has jumped up 67%, but it's a $2 stock. I'm not that interested. MARA, that's Marathon Digital for Bitcoin, jumped up 60%. So does this automatically mean like I'm going to trade these? Not really, right? I mean, Riot, Mara, that's Bitcoin related. Lucid, that's an EV play that I think is garbage right now, unless you're just going to toss money at it and hope it goes up. ChargePoint, it's 97 cents. I wouldn't touch that thing. So not all these stocks are great. But if I go to high option volume and go to IV, if as long as we have liquid stocks here, which a lot of these are liquid. So I'm looking to see, let me get this out of the way. Just go to the IV rank. I'm looking for liquidity. These should be pretty liquid. Let me check on one other thing here. Yeah, I mean, MicroStrategy is not always perfectly correlated. It has its own. I mean, we've got earnings on MicroStrategy. I know they're going to correlate to Bitcoin, but it's not going to be perfect. I don't know. I think it's an overvalued Bitcoin play anyway. It's essentially 2.5 to 3 times volatility. Let me look at a symbol here. Let me find. Let's go to PLTR. Okay, let me see if I can find something on PLTR. So we're trading at $80.12. We have a pretty decent bull call spread. Let me see what this one looks like. So an 80 by 100. Let me see if that's actually, I mean, that's a good reward to risk. Does anybody want this information here? Let me see if I can make this font a little bit smaller. Not too small though. There. All right. So if anybody wants this information, we take a screenshot of that so I at least have a reference point. Okay, so I can come back to that. That's weird. Oh, that's just a line. Let's go up here. Try that again. All right, now I'll take that screenshot. There. Okay, so reference is done. All right, I'm going to delete this now. Okay, and then I'll put another text box in. I'm going to try to go to 16. That should be a little bit better. There. That should be better for my font. Okay, I'm looking at PLTR. So I already have some trades on PLTR. I mean, this stock is like crazy explosive, and I don't necessarily want to call the top on this because I would like to look at like, yeah, maybe we could do like an iron condor. Maybe we can do selling the premium as earnings comes out in the next couple of weeks and it doesn't go as far as the market expects it to go. I don't think I want to do anything other than play the same thing I'm playing right here. I think this price on Palantir hopefully will pull back. Right? Like I want to see a pullback for me to add more trades, whether I'm buying shares or adding additional option trades. I want to see a pullback on Palantir. The concern is that this thing blows the top off and I'm just like, well, I guess this is full profit. That's totally fine. But I'm just going to be left chasing and wondering like, how can I get into this stock? And I just don't have it. So I'm going to wait. Okay. Ben, which trade are you talking about for NVIDIA? NVIDIA, I did put on an iron condor there as well. NVIDIA, I did if price is below 160 and 165, or price is the 115, 110. Now, I don't really want to roll NVIDIA because for me, if NVIDIA is down below 115, I'm actually going to keep the shares. I will keep the 115 assignment and I'll use the 110 put for my long put. And I'll lower the cost basis. I'll take the shares. I'll take the full profit on the 160 by 165. So I'll take the profit on that one. So if we go down through 115, I will take the profit at the 160 by 165. That should basically expire for full profit. The 115 by 110, I'm willing to take the shares at 115, use the 110 for my long put insurance to hopefully lower the cost basis if it goes lower. But something tells me that right off of this 200 moving average and through this earnings print, we're probably coming back to fill that gap. So I don't think this trade is necessarily threatened. I think this trade is fine. If it goes lower, I'm willing to take the shares. If it goes back into center, I am willing to, you know, take the full profit on this trade. So the $1.38, I've set a take profit of around 70 cents. I'm going after about a 50% take profit on this trade. Okay, but I'd like to take as much of that as possible. I mean, if we get a $1.38 to decay down to like 25 cents or 20 cents, then I'll take some profit there. Okay, yep. So there's still plenty of time on the iron condor. I'm just going to let it ride. And plus, I think we can get a gap fill, come back to the center price. And look, if we're back to like 140 and I'm still selling the 160 and the 115, this is perfect, right? That's priced right back in the center. And that's a bunch of noise. And this market allows me to grab some profit out of a trade like this. Make sense? All right. So, yep, that's a good trade. I'm looking at Palantir. There's some good upside potential. Let me see what it has for liquidity. Palantir, liquidity wise, it's pretty liquid. How many shares a day on Palantir? So we got average volume at 80 million. I mean, it's crazy liquid. But with earnings coming out next week, I think. Yep, next week on the 3rd after market. Let me price this out actually. Let me see. I don't think I'm going to take a trade necessarily, but it is in the S&P now. And I mean, the stock was the best performing stock in 2024. So we have a expected weekly trading range of around $7. Obviously, that's not fantastic. We have a market maker move. If I work this down, go back to PLTR. So next week after earnings, we go to 9 days out from today. It's 1160 move, which is a little bit higher, right? So big implied volatility. That's an 1160 move with a weekly average of about $7. Now, most importantly to me is what has earnings given me from the last 10 earnings prints. That's what I want to see. So if I go PLTR and the last 10, I mean, this is ridiculously volatile. 16, 16, 18, 18, 17, 20, 22, 20, 21, 21, 58 is the average. Conservatively, okay, what is an 11%? What's an $11 move on $80? 11 out of 80 is about a 13.5% move. That is what market makers are looking for, about 1160. So 1160 divided by current price, 79.93. So that's about a 14.5% move. Okay, that's what market makers are looking for next week. Now, if Palantir blows through the upside or blows to the downside, then possibly it's a cheap enough trade to take something that would be proving to go over the expected move. Now, based on what the last 10 earnings have given us, you know, I see 16, 16, 18, 18, 17, 20, 20, 20, 20. I mean, a lot of 20s since February of last year. I'm going to be conservative and say this thing goes 18%. Okay, 18% times current price of $79.99. Looking at about a $14 move on Palantir. Okay, $14 move. Now, here's one way that I can play this stock for next week. Before I jump into a trade here, I want to see how many times has this stock at least gone 18% over the last 10 earnings. Okay, so let's find out. And, you know, if anybody's interested in stuff like this, I have a course that should be coming in the next week or two all about this and doing the entire year with earnings. That is the play. So I price all this stuff out. I do this all by the numbers, and I try to find good trades. And I'm usually taking 20, 30, 40 earnings trades a quarter, and typically do pretty well with it. So it's all very systematic, but it takes numbers and probabilities, and we just trade to trade. But I try to look at good reward to risk, good probabilities, then a good trade. All right. So anyway, there'll be more information on that. You can find that in Telegram and Telegram and Discord. I'll post that in a couple weeks. So how many times do we get over 18%? Well, that one does after 1 day. This one does after 3 days. This one does after 5 days. This one does immediately. This one does after 1 day. This one does not. This one does. This one does. This one does not, and this one does not. So 7 out of 10 times it's at least gone 18%. That's a pretty good probability. Okay, so could I price in this move and say after 3 to 5 days, now Palantir is, what are earnings on Palantir? Earnings on Palantir, it is the 3rd of February, which is going to be next week on Monday. So if I went to the 7th, I actually have a fair shake in this trade. I can go to the 7th. I'm looking about how many dollars out? About a $14 move out. I'm going to see what $10 looks like. So if I go to 90 bucks, if I buy the 90 and I sell the 91, it costs me 20 cents on the dollar for that trade. Okay. That's not bad. That's not bad at all. If I go to the 71 by 70, so I go 90 to 91 or the 71 by 70, let me go to the 70 by 69. Okay, so I can get in this trade. If I win one side, lose one side, I still make profit. Let me see what this one cost me. That's not bad. It's slightly a 1-to-1. I can win one, lose one, and still make money. Worst case scenarios, if it doesn't go anywhere, if I did one contract, I risk 50 bucks. Okay, if I do 2 contracts, my risk is 100 bucks. But the winner here would be if I win, I'm basically getting $1 on the winner, okay, and 25 cents on the loser. So I would gain $1, I would lose 25 cents, but my debit is 50 cents. Okay, so if I win on one trade, I win because the debit would be 25 cents, right? So if I win $1 and I'm paying 51 cents, I walk away with about 49 to 50 cents profit per contract. So I can lose one side, win one side, and still walk away profitable. Now, if I want to make this a little bit more exciting, then maybe we go there and we go there. Now, it's about the same thing where I'm risking $1 to make $2. So it doesn't really matter which side I take. It's just what's my risk. You know, I can take 2 contracts or I can take 1 contract and make it a little bit wider. That's not awful. And that's not awful to go to 1 contract there. So risk $1 to make $1. Okay, if we have a big blowout move to the upside and this thing is well above $91, I can still make money on the trade. I would close this thing out for anywhere between like $1.50 to $1.75 if I want to protect it early, or I try to let it go to expiration to see if it stays above 91 or it gets below 69, and then I can keep my full $2 winner. Okay, does that make sense? So it's not bad. It does hit earnings relatively consistently at that 18% level. I'm only going up $10, which $10 out of a $80 stock. Oops, 10 divided by 80, fudge. I'm only looking at calculating about a 12.5% move, and this stock has gone 18+%, like 7 out of 10 times. So I think it's a pretty good trade. I'm not going to risk a ton on this. If price goes in the middle and stays in the middle, then I'm going to risk my $1 here. Okay, but if I risk $1 to make $1, I think that trade is totally fine. I'm going to take this trade. Okay, so let me see if I can get in here for $1. And right now, Palantir is right in the middle, and I'll set my box and see where we have to be above or below. And it's going to cost me $1. So let's check it out. Oh, come on now. $1. All right, $1. All right, not too much higher. I'm trying not to give myself a disadvantage on the risk. It's a slight disadvantage right now. All right, just got filled for $1.03. Just got filled for $1.03. All right, let me get that one posted. And that's a 71. Okay. The goal is to see price greater than 91 or less than 69 and look to protect $1.50 credit or more. Max credit is going to be $2. Okay, so I'm going to post that trade. That's going into my double up alerts. So 2/7 expiration. And buy the 89 call, sell the 91 call, buy the 71 put, sell the 69 put. There's a debit. Okay. So that is the trade for Palantir. I'm going to box that in. So if we're above 91 or if we're below 69, bear. Then if I'm above or below, that's profit. So greater than 91, less than 69. That's the trade. All right. And part of that was led by the discussion of what's a higher implied volatility stock. Well, this is one of them. Anything can happen. I just like to see that more money is getting thrown into the positive or the negative of Palantir. I don't know what's going to happen. It's going to be something to do with how optimistic the market is about their earnings. I would imagine with their stock price and going up, thousands of percent. Like this was a crazy mover since the lows. This stock has gone up 1,251%. I mean, last year, just for year to date, 2024, this was the best performing stock of 2024. At first, it was Nvidia, then it was SMCI, then it was back to Nvidia, and then you had you had weird stocks that were doing really well, but Palantir ended up being the leader, best performance of the year. But also, it was pulled in the S&P. They're in the aerospace. I don't know. I think they're just like this crazy innovative tech consulting firm that is making all sorts of partnerships, and people seem to love it. So I am taking an earnings trade, and then I'm doing a bunch of stuff down here. Like I want to own it, but I want to own it cheaper. So I'm trying to own it cheaper. Okay. So it doesn't matter if I'm confident on one side or the other. I'm trading the mechanics of earnings. Earnings, you have little to no edge in earnings. Earnings is really a coin flip, and it's based on, you've got some market maker flows, you got some liquidity levels, stock price is good or bad, but it's all swept up in overall sentiment. It's like earnings is, you can do all the predicting that you want. Earnings is, it's just stuff, And so what I'm doing is I'm looking at to see like what are the probabilities of this stock moving, how much does it need to move, and can I make the reward to risk favorable? Okay. All right. Bell just closed. S&P for the day, this was pretty wild. Nothing happened. I mean, honestly, nothing happened. So we started here today and we finished here today. So this market did pretty much nothing the entire day. Yes, it had a little excitement during FOMC, but nothing too crazy. There's still a 595 level and a 610 level. I did take that trade for my double up service, trying to go after both sides. We'll see what happens. We still have Mag 7 earnings. Obviously, everyone's going to be anticipating Tesla aftermarket today, Meta aftermarket today, Microsoft aftermarket today, and we'll see if there's any big movers. I don't know if we're going to get to them right away while I'm live, but I'm probably going to wrap up here in the next minute. I got a call in Arizona. So right now, Tesla, I don't see anything post market. We'll see what the earnings give us. Microsoft. Microsoft looking to come down a little bit. All right. Clearly there's some earnings going on there, right? So 442 is the close today. It's jumping all over the place after an earnings report. So again, initial reaction looks like Microsoft is lower, and we'll see how bad it is. I will say this on Microsoft though. If we're opening, and I don't know where this is going to be and this is going to settle, but we'll see what the earnings print shows. But if Microsoft is back down towards this level, I'm probably taking more income trades. I think this is a good range on Microsoft for right now. Okay, and then Meta. Meta post market is around the same, so we don't really have a initial reaction out of that one, but keep an eye on it. Okay. All right, I'm gonna go. That was a fun session. Got a new trade in on Palantir. I got a couple trades in today. So SPY, I'm looking at 610 or 590, and I got a trade on Caterpillar for the end of the week. I've got the Palantir trade in, and also did some rolls and daily profit play. We are doing pretty well this week on daily profit play. We are, for the last little bit, we have how many winners in a row? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. We have 10 winners in a row on daily profit play for the last couple weeks. So we'll keep rocking and rolling there. All right, cool. I'll let you go. Almost, Penny. Almost. When you see me holding him while we're trading, then yeah, he's going to soak it all in. I need him to be able to smile and mirror my face a little bit. So, but when it comes to reading time, yeah, I'll just read him financial books. He's going to learn all about options. All right, cool. Thanks, everybody. I'll see you tomorrow. Bye.